Hello, my name is Kevin Carlson. I'm a mortgage broker here in Canada. Thank you so much for joining me on my YouTube channel to learn a little bit more about mortgage financing. Today we're talking about the difference between pre-approved and pre-qualified. Now, you may have seen signs and advertisements from different banks saying, get pre-approved in 5 minutes or get pre-qualified in 2 minutes. Well, it takes significantly more than that to actually get you pre-approved. Pre-qualified is just kind of a very basic term for just looking at your debt service ratio numbers. So we're going to talk about the difference between those two today, where if you get pre-qualified, you're certainly not ready to go out and shop for houses quite yet. So getting pre-qualified just allows you to plug in your own numbers when it comes to your income and your debts, and then it figures out about how much you're pre-qualified for a mortgage based on the mortgage stress test. This is done using debt service ratio calculations. It takes your gross household income as a ratio up against the mortgage and taxes and any condo fees for the home that you're purchasing. It also factors in any additional debts on credit cards, lines of credit, and loans. So the pre-qualification process is just very quick math. It's similar to taking your car to your mechanic and saying that it's not running right and there's a problem. So you pull it up to the bay door and the mechanic lifts the hood and just kind of looks around with a flashlight and says, okay, now we're pre-qualified to bring your car into the shop. Not really any work gets done, it's just sort of a quick look. So the maximum debt service ratio that you're allowed to have of your gross household income up against the mortgage and taxes would be 39%. So for easy numbers, let's say we have a family that earns $10,000 per month gross verifiable income. Using the GDS, or your gross debt service ratio, up against the mortgage, the taxes, and any condo fees, that family cannot spend more than $3,900 per month on those items. Now, the total debt service ratio is can be a little bit higher than that. So that includes the mortgage, the taxes, and any condo fees, plus any additional debts. The maximum total debt service ratio can be up to 44% with excellent credit. If your credit's not quite as good, then we have to stick under 40. So that's about it for getting pre-qualified. There's no credit checks, there's no looking at any pay stubs or any bank statements to verify down payment. It's a pretty basic process. So let's talk about the actual pre-approval process rather than being pre-qualified. My first step to get my clients pre-approved would be to take a full and complete mortgage application. I typically do this either in person or over the phone. I find that when clients submit a mortgage application through my website or just sending in documentation, just a printed off application, quite a bit can get missed. It is very, very important to make sure that I speak to the clients to be sure that I have all the details when it comes to their credit, their income, and their down payment. I did a previous video when it comes to taking a full mortgage application. I'll link to that video in the description below, where I go over a complete mortgage application from start to finish. It gives a pretty good overview of what you can expect when you speak to myself or your mortgage broker when it comes to applying for a mortgage. Even though I went through the application process pretty in depth in that other video, here's just a little bit of a quick overview. The first step is to get your full name, your address, your telephone number, social insurance number, and your date of birth. And I also need an employment history for the last 3 years. I need the name of your employer, your position, whether you're full-time, part-time, permanent, or casual. I'll also need to know if you have any other secondary income, so like a child tax benefit, spousal or child support, or if you have a second job, a part-time job, or a secondary business that earns you money on an annual basis. I'll also need a full list of assets, so any vehicles that you might own, snowmobiles, boats, quads, RVs. I need to know RSPs and pensions, mutual funds, and any other investments that you might have. During the pre-approval process, I very often will have the client sign a consent form so they can access their credit reports to make sure that the credit is satisfactory. Sometimes I'll ask for some pay stubs, T4s, and if you're self-employed, there's going to be quite a bit of documentation I will request up front. So anybody who's self-employed, I need your T1 generals, as well as your any incorporation documents and notice of assessments, all for the last 2 years. Anytime I'm working with somebody who's self-employed, I want to make sure I have at least 2 years of these documents sitting in the file, ready to be submitted to the lender. Sometimes people who are self-employed don't always keep some of this documentation on hand. So it's good to ask for it up front, so that when they found a house that they're going to purchase, that they're not scrambling to get their hold of those documents. Sometimes they'll even ask for copies of the last 3 months of bank statements or investment statements just to verify that the down payment funds are there. So let's go over some of the things that can foul up a mortgage application that I always try to avoid, and make sure that once I've sent clients out there with their realtor to purchase a home, that they're actually going to be getting a mortgage when they do find that house. So as I mentioned, I do pull credit reports most of the time, and there's some things that come up in the credit reports that people might not be aware of that can foul up a mortgage pre-approval. So if you have any collections or any bad debts that are unaddressed, those certainly need to be looked at, and that can certainly keep you from getting a mortgage down the road. If you only have one credit item, like let's say you have a credit card, but you have that credit card with a joint applicant, like a spouse or even a parent, sometimes that credit card might not show up on your credit report. So if you're counting on just having that one credit card being your credit history and helping establish your credit score, and then it's not there, that can be pretty devastating. So having no credit is almost as bad as having bad credit. If you've just recently started a new job and you've only been there for a few months, sometimes you could be on a probation period. Most of the time, 3 months is what you can expect for probation, but there are some employers that have a full 1 year probation period, and sometimes we can get an exception to have the lender waive that probation where they're still going to give you a mortgage. But quite often, if you're new to that industry and new in that field, then we might have to wait until that probation period is fully passed. So if you've been working with an employer full-time hours over the last year or so, and your understanding is that you are permanent and full-time, but then that employer, for some reason, actually has you classified as casual, well, that can certainly throw a wrench into your pre-approval process pretty quickly. So these are good things to find out during the pre-approval. Looking at some bank statements or investment statements can be important because sometimes investments are locked in. So if somebody has a sum of money that's all or some of their down payment, and they didn't realize that that investment was maybe a term deposit or something that has you can only access those funds at a certain later date, well, that's certainly going to put you in a bit of a pinch to try and get access to those down payment funds. Another thing we have to look for is deposits to your bank account where your down payment is for the last 3 months. We have to make sure that all the deposits to that account are verifiable. So if you have any deposits to your account that can't be quantified by payroll or say the sale of a vehicle or even another house, well, then we have to ask a few questions. If you've transferred money from a line of credit or a credit card, or borrowed it from a friend who is not a family member, well, we need to address that at the pre-approval stage for sure. Quite often when I'm working with people who are self-employed or even commissioned, and I ask them what their income might be, well, sometimes they end up giving me what their company sales are for the year, rather than with the number that we actually use is their personal taxable income. So quite often, that's why I do ask for the T1 generals and your notice of assessments for the last 2 years, so they have those in the file and can actually verify that the taxable income is what you said it was. Another good reason for people who are self-employed for me to have their notice of assessments is to ensure that their income taxes are paid and up to date. If you owe Revenue Canada any money for the previous tax year, the mortgage lender will require that you get that paid up. The biggest reason for that is that in the event of a foreclosure, rather than the bank being first in line to get the money, then it's actually Revenue Canada. So if banks are always on the lookout to make sure that if there's any income tax owing for a client, that that's been addressed, and that if there's a foreclosure, the bank gets paid first rather than the government. If you're counting on a second job to be used as a pre-qualification income, then we do need to look at pay stubs for that job as well as T4s. The reason for that is that if you have a secondary job and you're counting on that income, we can only use it if you've had that job for at least 2 years. So I will often request pay stubs and T4s from that second job for the last 2 years and be able to use that as a secondary income on a 2-year average. So that's about it for the difference between pre-qualified and pre-approved. So if you're not sure if you've been pre-qualified or pre-approved, if it took less than 5 minutes, you've been pre-qualified. So a pre-approval process takes at the very least 15-20 minutes just to take a mortgage application in a proper manner. Going through that process too quickly and missing any details in your application can throw a huge wrench into being able to get a mortgage once you found a home. If you have any questions about getting pre-approved or pre-qualified, please put it in the comments below. Or if you'd like to get pre-approved to purchase a home of your own, certainly contact me through my website. I'd be happy to work with you. Thank you so much for your time and have yourself a great day.